In this recording, I want to cover the 3 inventory accounts that a manufacturer would have. They were introduced in Chapter 2 of your textbook, and they are the materials inventory, work in process inventory, and finished goods inventory. All 3 of these would be assets on the balance sheet of the manufacturing company. This is different than a merchandiser who would have just one inventory account. Pretty much the equivalent of our finished goods inventory. They buy their products ready to sell. So they buy them already finished and they sell them to their customers. So the amount they have unsold would sit on the balance sheet waiting to be sold. As they're sold, the cost of them is removed from the inventory account and put into an expense account called cost of goods sold. It works the same way with our company, our manufacturer. We would also have a cost of goods sold expense account. So let's put it up top that it's an expense. And all 3 of these are considered assets. Now, we're going to talk a little bit about how costs flow in and out of these 3 accounts. Materials inventory is the account that holds all the raw materials that we're waiting to use in production. The only way amounts go in here is if you buy raw materials. The amount you spent to buy them will go in this account. The only way they leave this account is when we use them, or fancy language of the textbook, put them into production. So if we use them, that amount will be subtracted away. So let's put a minus sign in front of it just to kind of remind us that it'll, yeah, I tend to like to type the wrong things when talking and typing at the same time. There we go. We'll minus away the ones we use, and that will give us the ending balance in the account. The amount that we use goes over to our work in process, and it becomes one of the figures we put in work in process. Work in process represents the products we're currently working on making. All the costs sit there and just accumulate. When the products are finished, then we'll move the amount of money we've spent or costs we've incurred in making them over to finished goods. So one of the costs is direct materials. The cost of the direct materials that we're using in production comes out of materials inventory and goes into work in process. Other costs that go in here would be direct labor and overhead. Both of those would come in from some calculations, and direct labor from timesheets. Payroll department determines how much of all the employees and all the hours they worked were for direct labor, directly working on making the products, not supervisors, not the office staff that help support the factory. All that would be considered overhead or indirect labor. So the payroll department is going to help us feed into the labor costs. And we'll kind of make from the payroll department. And overhead will be from a separate account called overhead. Someone's keeping track of all those overhead costs and determining how much of our overhead has happened this period. I don't want to get too far into overhead. That's something that's going to be a big topic as we move along in our chapters, but for right now, know that those numbers are fed in by other calculations. So as goods are being made, direct materials, direct labor, and overhead are dumped into the work in process account. Let's assume that there were no items half done, partially done as the month began. So they began with 0 in their work in process. Everything from last month or last period was completed when the month ended. So as this month goes along, materials are brought in, labor is spent on the products, overhead is spent on the products, and you will get a grand total of all the costs incurred this period. These are called product costs. That total is not what we've been calling cost of goods manufactured. Got one more step to go. I'm just trying to get this to fit in here a little bit better so you can see it without being too long. We need to consider if at the end of the accounting period, were there any of our products that we were making that didn't get finished? Because we're going to transfer the amount of money here, all or part of it, over to finished goods. The question is, how much of it should be transferred? We're going to move the goods that were completed, the cost of the goods that were completed. So we need to look at ending inventory. Someone goes through, this sounds great in theory, really difficult to actually do. I'm going to go through and determine how much of what we're producing is still in process and how much is finished. They can count the number of products and assign a dollar amount to it. We will have whole chapters that'll help us decide the dollar amount that goes along with the products that are still sitting on the factory floor. Somebody comes through and says, left in ending inventory is this much money. The cost of making those items that are half done, 3/4 of the way done, they take that away from the total costs in this account, and that gives them cost of goods manufactured. And I'll abbreviate because I know you've seen that 100 times in the discussion board and in your reading. It's that cost of goods manufactured that is transferred here to finished goods. There might have already been items in finished goods that you made in other periods that have not sold yet, unsold inventory. That's what that would be considered. And then our cost of goods manufactured gets added in. And we will subtotal that and call the subtotal goods available for sale. That was what we would call the inventory balance that we have available to sell. What we had in the beginning plus what we made would give us what we have available to sell. There's really only two choices of where that stuff is at now. It was available to sell. It was either sold my arrow does not want to be nice to me. There we go. Or it's still here. And again, the way we start is they go count what's still here, what didn't sell this period. I'm going to take that away from what we had available to sell and say, well, if it wasn't still here in the store, it must have been sold. They will call that the cost of goods sold. And that amount is then transferred to the cost of goods sold account and put on the income statement as an expense or a subtraction away from the net sales. So that's the flow of our accounts. When the month is over, we will report on the balance sheet the ending balance of materials inventory, the ending balance of work in process, and the ending balance of finished goods. Those three together go on the balance sheet. The cost of goods sold account and its balance will be reported on the income statement and can use to compute our gross profit and eventually our net income. You'll need a good handle on these flows of these costs as we're going through the material. We've given you a real brief overview here. There's a lot that goes into just trying to figure out what is the cost of the materials that were used. How much overhead, should I say, is being applied to these products or being used in production? How do I decide the cost of what's being transferred to finished goods? And what about the number of units? We're going to be putting all those pieces into the puzzle in a little bit. But right now, make sure that you can follow the flow of the accounts.